So we are going to talk about insolvency and bankruptcy regime in Canada. So this is quite a hot topic concerning the economic trends and the economic situation the country is going through right now. And since the past couple of years, there has been some, ups and downs in terms of the financial sort of measure that been taken by Bank of Canada too. So we will discuss quite a brief about how this regime is working, tools, how you can support your clients or somebody might help from it. So we are going to begin this. So before we begin, I would like to tell you that this whole presentation is just for the information and education purpose, and it won't be constituted as any financial or a legal advice. For any sort of particular situation for yourself or any of your clients, you should reach out for a personal one-to-one consultation so you can see how and which options are sort of helpful for the situation and legally also viable for your clients and your situation. And in the meantime, I would like to tell this is, I would like this to not rather be a monologue. And if there's something or a thought that come across while I'm sharing a subject matter or any sort of facts here, I will really appreciate if anybody can come up and, try to more, let's make it more interactive and two-way streaming rather than one. So who am I? Okay, I look all right here compared to what I'm on video. So again, I'll Sudhanshu Marwaha. I'm an insolvency trustee. I'm a CPA. So these are my designation pretty much. From a small town in India. I've quite worked. I've been an accountant in SMB sort of firms in India, worked with EY in India before. And since coming to Canada, I've been in this industry. So about more than half a decade I've spent in this industry and really got good experience and sort of learnings and have good sort of seasonality in terms of different issues and try to resolve the problem. So we sort of in our profession, I tend to give a analogy that we act like a firefighter, but in the finance world pretty much. So whenever there is a problem, financially, quote unquote, either for business or individual, a licensed insolvency should be somebody who should strike your mind, just like a firefighter when fire comes along. So, so we begin. So why finance professionals, especially everybody who's joined in right now, why should they know about this? So often, you guys, being a CA or somebody from a finance background, your first point of contact for your clients or family member who will reach out to you to understand what's the situation they are in now, some trouble they got, some CRA letter or a bank called the loan. So you guys are point of contact for first for those, like you are the first responders, like first aid. If I am a firefighter, you are the first aid guys on the spot, right? So you would get to know about all the tools that's available to help your clients and family when whether it's the debt restructuring, protection of the asset, or bankruptcy. And then we'll drill down into the legal frameworks, how these can actually work. So why it's crucial, like we discussed even when we began, why it's crucial to understand the insolvency? Because right now there's mounting pressures on both businesses and individuals, as you can see even from the Q3 report from Equifax that come. So the trend in terms of the, I can say, the missed payments on say mortgages or even on business loans and particularly SEBA loan, they're quite high, which are essentially the factors or indication that the businesses and individuals are in some sort of financial trouble and they're not able to make their ends meet or able to pay down their sort of debt obligation as they come due. So let's talk about a bit of trends that's going on in the insolvency regime right now. So per a recent study, the insolvency trend is at about all-time like 15-year stretch high. So it's about last at 1,312 companies filed for bankruptcy just in the Q3 2024, which is actually the highest levels since the 2009 financial crisis, as you can imagine. That's a big stretch, like in 1.5 decades, nobody's seen this sort of, and we are expecting this thing to continue until this year as well, at least for the Q1 and Q2. So the particular sectors which are seeing the biggest pain are say retail, real estate, trucking, hospitality, oil and gas at a bit, like oil and gas has been good quite pretty much in during COVID because the prices have been high. People were still, going out, but now ONG is also getting a bit of a heat and it's back. Like oil and gas sector has usually been termed as a gold mine for the insolvency professionals, like in Alberta, right? But right now, during COVID, they were quite stable because prices were higher. They were able to get good revenues. But now things are changing quite a bit. There's one interesting start as here as well, as you may know. SEBA loan, Canada Emergency Business Assistance, which was initially $40,000 of assistance, went to $60,000. So recent status that more than 25% of the people, they've not been able to repay, or if they have a schedule to repay it back in say installments or something, they were not able to do so. And this is from the federal government stats, because it was federal unsecured and federally guaranteed loans, so to keep track on what and how it's going about it. As you mentioned, construction has also been one of the real estate, because it's been a highly leveraged industry, and due to the interest rate high and low, while because of the monetary policies of Bank of Canada, so construction and real estate is one of the sector which is pretty much on the front line. Like I myself am dealing with bunch of real estate files that we are working for creditors, or on the debtor side when people are not able to close on their APS on a pre-construction. So these few are the sectors which are say quite in terms of volume and in terms of impact that's going on in the whole economy. So in terms of factors, there are various factors that goes on to reaching to this trend, which are say a weak economy, and as you can imagine, the unemployment rate, which is even inflation is a bigger challenge, but even from inflation, the bigger challenge is an unemployment, right? 6.8%, quite high. And then we are seeing rising interest rate, which are now pretty much coming down. But due to the recent this monthly data, there was good employment numbers went out. So maybe in the coming next sort of announcement, we might not see a high chances of another rate cut. And then again, US tariff, that also pretty much concerns by next is couple of weeks we'll see US President Donald Trump joining in, and of course there's a threat everybody's preparing for a tariff war. And because 67% of the exports of Canada is pretty much like biggest partner is US, so this can really jeopardize or could be a bigger risk. And all the government at municipal, provincial, and the federal level, they are sort of preparing for this war with US. And we are pretty much hopeful to see how this goes on and how it will also fluctuate the forex sort of exchange currency on CAD versus US, which has also been sloppy quite a bit. It did touch 68 cents on a dollar recently, but it came back on, and so we'll see how that goes. So as we mentioned, we've already, I think, discussed there was a a bit of rise and lowering down the interest rate. It causes a shock. Like economy in terms of India and Canada is quite different. Like we most of the professionals here are so Indo-Canadians. So in India, economy is not as leveraged as it is here in Canada, right? So whenever there's a shift, say in interest rate going down, so leverage is such a tool. If you can take benefit out of it, it can take you like sky's the limit pretty much for it. But when the leverage goes against you for whatever reason, it can really drill you down and pretty much wipe out the whole business or the economic situation of an individual as well. And inflation, because of the interest rate, monetary policy changes was a byproduct on it. And right now, like we discussed, there are various uncertainty going on due to various reasons for the Canadian economy, and pretty much a big sort of slowdown. Even when we are speaking with a lot of clients or people that we come across, there's not that sort of positivity around people in terms of confidence in Canadian economy. As you've also would have seen, there's quite a big trend of people migrating back to India. So people have, or businesses, people are a bit hesitant to make new investments, and as such people are not spending as much as they would. Like GST HST holiday that was introduced by both federal and Ontario government, it has really given a good boost to the economy as well, but it's an artificial injection, right? About 13% incentive to the people to spend more. It's really helped, and that's part of the reason there was a hike, or say we can see a rise in employment numbers in the December month. But pretty much there's not a strong sort of confidence in the business sort of community as of now in terms of Canadian economy. So I'll give you a brief about all the tools that we are going to discuss today. So first we'll side for the debtor side. So debtor and the creditor, I'll give you uh, the term how it is. So debtor is somebody, say could be an individual or a company who's basically taken money from a bank, or essentially lent, sort of borrowed money from a bank or a private institution or a family office for various reasons. Could be a car loan, could be for business. Like that person or that particular sort of business is called a sort of debtor. And the creditor would be a bank, a family office, a credit card company who's lent out money. All right. So these tools, four tools you can see on the screen, these are for the debtor side of the work, which is individuals and businesses who sort of borrowed money. So one would be an ideal sort of, and we are seeing most, say, bulk of the filings that's going on for consumer, like individual consumer would mean an individual, a real person, would be a consumer proposal. And this pretty much cover on practice side of about 67 to 70% of the filings right now. So it is suitable for individuals who have debts which is up to $250,000, except any debt that's on their, say, home, like a first mortgage or a HELOC. So you can use this tool to restructure all the debt that an individual has, other than the debt on their home, and an HELOC, like, which is mortgage on their home pretty much. So could be line of credit, CRA debt, could be car loans, like various sort of unsecured loans which is not attached to their residential house, right? They can cover in that. Then individual bankruptcy. A lot of time people are in a situation that filing an individual bankruptcy is a better option for them. Maybe they don't have a stable income. Like in consumer proposal, you are offering sort of a lower payment. Say somebody's or say 200 grand, right? They can't pay 200 grand. They'll do some analysis and stuff. They might want to offer that, hey, we can't pay 200 grand. We'll pay 80,000 and over the 4 year stretch or 5 year stretch. That's part of a consumer plan. Then individual bankruptcy, in case a person doesn't have that much disposable income in place, and then they might want to use that particular option. Usually people tend to go to the proposal route because of different sort of advantages, because it doesn't have as bad as credit rating as a bankruptcy would, and it doesn't stay as long as sort of compared to a bankruptcy. Like bankruptcy filing by an individual gives them an R9 rating on their credit report, which can stay up to. So bankruptcy, like, is the status. You get into it, you get out of it. Getting out of it is essential. It's called discharge. So depending on two credit agencies that we have in Canada, it can take after discharge about 7-8 years. So if somebody, give and take, is in bankruptcy status for a year, then another 7-8 years. So that status or the rating that's bad on the credit profile can stay on for about 9 years or 10 years, and maybe stretch it out as well. But in consumer proposal, the rating is lower, it is R7, and then the rating R7 stays on onto the credit profile only up till 3 years after the last payment is made. Say somebody propose that they're going to pay in 5 years, but instead they can pay it earlier as well in 2 years. So 2 years plus the three, so 5 years. So almost half the time that the credit profile is pretty much on a bad scenario, and also you are in a R7 rating, which is not as bad as R9. Okay, so next one is a division one proposal. It is used by both individuals and businesses. Like consumer proposal can only be used by individuals with a certain threshold, right? So somebody who has debts exceeding that amount, they can use division one proposal. It's more complex, expensive. You need to go to the court and a lot of stuff, but it offers a lot of flexibility. You can be really creative with payments, and even businesses, they can use the same. So filing each three of them, actually, when you file it, it gives you an immediate stay of proceeding or action. Say somebody is enforcing, CRA is enforcing, banks are enforcing, or a vendor or a landlord is enforcing, right? So it will stop the action right away. You might have heard in, like in India, people go to the court when there's an action being taken and take a stay from the court, stay of the action. So filing each of these can give an immediate stay right away. Like I'll give you an example of one case that I had in division one filing. So there was a business which owed considerable, like $4-5 million in CRA debt. So CRA has like really good powers to action and to collect these debt. What CRA did was they took out about $200,000 at 11 a.m. from their bank account. They wrote to the bank, bank took out the money sitting in their company's bank account and sent it over to CRA. So we filed the division one proposal filing, I guess only 2 hours later, maybe 1 p.m. So the stay happens for the whole day. So it pretty much, the clock went back until the midnight of, so in that scenario, we were able to get back the $200,000 from CRA, and at the same time, we sort of negotiated that payment down from 4-5 million to quite a fraction of the amount, and to be paid over a period of months, interest free. And that 200,000 was essentially now being used as a down payment towards what the offering was. So that these sort of things really sort of make a big difference. The timing is quite an important factor. That's the reason I use the term firefighter. Just like when there's fire, the late the firefighter gets in, it's harder to basically salvage or try to save the whole situation. Similar is the situation here. The timing is really crucial because all these tools have different sort of advantages that come along, but you want to make sure that you don't miss on a deadline. Like in that scenario, say the business came with us or to us to file, the other next day we wouldn't be able to get that $200,000 back from CRA, and it would only reduce, say, from 4 million to 3.8, correct? But then the whole negotiation part goes from it, because the way it works in the restructuring, we sort of give them an option B, that okay, if you don't accept the offering that's by the business, what is your chance and what is your net equity recovery that you can expect from the business, and if there's liabilities that they can go to the director, what you can get out of it, right? So that stays the same if the 200,000 was pretty much taking out the gross value. So it's quite essential the timing that you reach out to an insolvency professional, insolvency trustee, that to able to fully utilize all the powers or all the advantages that a whole sort of regime has to offer. Then comes the corporate bankruptcy. So this is also one of the tactical sort of way to deal with that. So there are many sort of unsecured debts with sort of company level which can be dealt with filing a corporate bankruptcy. Could be some loans which were unsecured, doesn't flow down to the director. So we'll discuss in the next sort of slide about it. So even though we've discussed a bit about it, we still go a bit more drill down into each of these four options. Like I mentioned, it's a debt relief tool by for the individual. So it acts like an agreement between creditors, right, who's owed money, and the borrower, the individual here. Okay, and it can cover again amounts up to $250,000, excluding any amount that's owed on their residential house. Say somebody has $700,000 of mortgage and a HELOC of $100,000, $800,000 on it. Then they have another $200,000 of unsecured or other debts apart from these. So they can use this tool to basically restructure or to solve the problem for the $200,000 of debt, and the other part of, say, their first modern HELOC, they stay intact. They don't get covered in this particular sort of tool or the framework. What it does, it will stop the action. Say a lot of companies or say credit card companies may go and garnish your wages, right, to your employer and say, hey, 30% of this individual's wage you send to us. They can do it. Then they can maybe freeze the bank account as well, and maybe then they can try to enforce the assets. So filing this gives an immediate sort of protection for all these action. Everything stops, even though there might be a small claims going in the small claims court proceeding as well. So that will stop. This will filing this would stop that as well. The whole framework, how it works is you file this like an offer is filed out, then you sit tight for 45 days. So the creditors, say the bank, whosoever is owed money, they have 45 days to essentially give their opinion on the offering. So either they say yes or they say no, or they say nothing, right? So if nobody comes back and doesn't say nothing in 45 days, so it's we don't need to go to the court, but it automatically becomes a binding contract. What it mean is whatever the individual has offered in that proposal, as long as they are gonna pay that money and they don't have to pay to the creditor, they pay to us trustee, we administer the whole process. All right, as long as they are now paying the amount that's offered in that agreement, the creditors which are listed in that thing in the whole package, they can't take any further action on the individual henceforth. And the proposal sort of payments that you are offering, it will be interest free. Like essentially, if I we'll try to keep this as efficient as it want, but essentially people can sort of settle their payments just on the total amount that they would otherwise have paid in interest over the 3 or 4 years on, say, $200,000. Like this could be really beneficial, but there's various calculations that goes on to come to a number which the creditors are likelihood to be accepted. Share with you a case study, and I'll show you a sort of a good scenario where this can come into play. So during COVID, a lot of people made a lot of money in real estate. Of course, pre-construction, you book it, you don't close it just before the close. You sell it again, assign it to somebody else. You make a good sweet $100,000. So you put about 30,000 in deposit to make 100K, three times the money, 3 years, really nice. But now things changed, right? So real estate is in really harsher condition. Things are not moving. Say now the builder unit is ready and somebody is not able to close. The reason could be the value of the unit itself went down, and banks are only going to cover the 80% value of what it is today. Say somebody booked it at 700,000, paid $50,000 at deposit. Now they're going to the bank, and the bank does an appraisal, and it only comes to say $600,000. Bank's only gonna fund 80% of the $600,000, which is 480. So the person initially thought they'll have 50 down and they could put another 90 there, right? But now there's a difference. So a lot of time, what people are doing right now, who they are trying to plug this difference either from they took a HELOC on their property, or maybe borrow more money on a credit card, or different ways to plug that money. A lot of time people are not able to plug that as well. So in that case, what happens? It fails to close. Builder is gonna sell it to somebody else, and then say they sell it a lower price, and that gap which you were not able to fill, they're gonna of course use their deposit towards credit to that as well. But there's then additional legal cost that they are gonna incur to changing and selling to somebody else. So that difference, builder is gonna sue you, not means you, to somebody who's booked and couldn't close, suing you, taking you to the court, and if you don't answer it, then they have a judgment from the court, and then they can go down and put a lien on your home as well to collect on that debt. So in case the timing is pretty much you time this well and you see a insolvency trustee at the time that you're not able to close, you can explore an option on filing a consumer proposal. Because keep in mind, this all these sort of tools, really all these debts have types: unsecured, secured. Each of these have different sort of pros, cons, advantages, comes with different features, what a creditor can do on secured, how those rights affect. So it's quite a sort of different ball game in terms of what can be done and not be done by a bank or a creditor to enforce on an unsecured versus a secured debt. So until you don't close, the number is not crystallized. It can be number, might be a bigger number too. So it's an unsecured debt at that time. So like we just discussed, consumer proposal can be used to settle the unsecured debt. So you might not have to take a HELOC. You might not have to borrow from friends and family or on a high interest credit card to close if you don't want to close, right? So you can use the consumer proposal to pretty much block or get out of that problem or a failed APS on a pre-construction home that you're not able to close on. And same, you can use this for settling credit cards, line of credit, car loans, any sort of unsecured debt. It can be as creative as you can think of it, but this is a really good tool and pretty much used, and it's not that expensive, quote unquote, too. So now it's going to be individual bankruptcy. So this could be essentially somebody who's owed a lot of money. They're not now in a position to make a viable proposal. They might not be now in a situation to earn good enough money to basically make a good proposal. So there can be a good option for them to file an individual bankruptcy. And just to know, a lot of people think that filing a bankruptcy is pretty much swipe, everything's gone. You can't keep anything. So it doesn't work like that. So there are certain, every provincial government, like say Ontario, Alberta, they have different rules what all assets can be, enforced by a trustee in an individual bankruptcy. Like in Ontario, there are various things that a trustee can't enforce, which is RRSP sort of contribution, which were done 12 months prior to filing the bankruptcy. Could be equity if there's a car in there, car which doesn't have equity. Don't quote me the right number, about 7,000. So a certain list of assets, even though somebody files, an individual files a bankruptcy, those won't go away in the bankruptcy. And I'll tell you one sort of good sort of or a unique fact about it. So in Alberta, it's called one of the sweethearts of individual filing bankruptcy. There's also a certain element that person can file a bankruptcy and not lose their home and also land. I won't get into details in terms of what those actual numbers are, but all these assets, there is a good list of assets which are exempt, which can't go away or taken by a trustee or the creditors when somebody files a bankruptcy. So they can understand what all assets, if anything, would be taken away from them by filing this as well. So I'll give you a case study. In this case, we got somebody who say wanted to settle on their debt. They had about 400,000 or $500,000 of debt, and for some reason they were not in a position to earn good income in going forward in the future. Henceforth, they were not able to make a good proposal. Like they were not able to make a proposal to pay 20% of what they owed. Say they owed 400,000, they were not in a position to even offer $80,000 to pay back, of course, over the installments period as well. So the guy filed the bankruptcy. The bankruptcy is essentially like a whole restart of their financial life. Of course, the credit rating is going to impact, as we discussed. R9 stays up to 7, 8 from the discharge date, and then they have to report to a trustee. But this can essentially help them to get out of a sort of bad scenario which they otherwise couldn't. Also, I would like to mention one thing. There's a lot of things going around currently in the market about bankruptcy. There's a lot of financial fraud being taken place openly on social media where people, I'll give you one case scenario. They're saying a lot of people who are going back to say India or their home country, they are essentially trying to game the system, wherein they are gonna sort of framework that they're doing a business or something. They'll take as much debt risk as possible on the pretense by all these players who are sort of getting a big chunk amount of money doing these fraud, that hey, you get the money, spend it or do anything, and then you file the bankruptcy, you are good with it. I would like to mention and tell people that hey, in the Bankruptcy Act, there's specific provision which says if you took money which was on false misrepresentation, and it could be termed as fraud, those debts are not going to go away from your profile in even filing a bankruptcy. So even somebody did a fraud or a misrepresentation to any sort of bank or a creditor, and they think that filing bankruptcy they will be able to wipe it out. I would like to tell that that's not the scenario. If creditor is able to prove or trustee is able to see that, because we can review the bank statement of the person, we can go as back as 5 years, and we can do sort of financial investigation, or say, I can tell you forensic work as well if required be, and get to know what was done. If they spent money crazily in terms of not responsibly, I can tell. So there's certain provisions which will catch it, and they can't use or game the system. All right. So next one is division one proposal, again used by when there's more debt even for individual. Like in this instance, I'll share with you an example. I'm helping a individual who ran their business under sole proprietorship, and he has like millions of dollars of CRA debt. So division one proposal is one tool that we are helping him restructure his debt with CRA in the instance. And again, businesses don't have access to consumer proposal because that's for a real individual. So they can use division one proposal to essentially stop the action. One, everything stops. Like there might be 10 problems. Say landlords not being paid, CRA has an issue, banks are pulling off, vendors are pulling off, right? So you stay all those actions, right? You stop everything, then you can restructure the income statement issue, sort of elements as well. What that would mean, say a company has 5 departments, they are into the situation because they've been burning cash since 2 years, because two of those departments were negative cash flow, or they were burning cash, and now they don't know how to get out of that department, or in terms of, you can't just close down or get out of a lease otherwise, right? And it's quite a big cost to close it down. So when you file, you stop the action, you can restructure the income statement, like take out the bad part of the business, essentially is using more creativity to make a rejig of the organization so it can work in a positive cash flow basis in the future. So you stop the issues from the past, you get some period here, like initially 30 days, but can be extended going to the court. So you stop the action, you rejig the business, took out the bad part of it. Now future it's cash flow positive, and then the debts that's owed up to onto that date, you can do again a proposal, and proposal can be as creative as you may think. All right, to settle and stretch those into interest free payments up to 60 months. But then it depends types of creditors, what are their sort of avenues. They have a secured creditor, a priority creditor, an unsecured creditor. Like for CRA, you can pretty much sort of use one segment in terms of like HST, those have different sort of rules in terms of, or different avenues for collection. But for social deduction, is different. So you really need to make a creative sort of a proposal to deal with this situation. But this can really help. Like share with you a case study during COVID. There was a one multi-location franchisor that we helped. They had like about 40 or 50 franchise locations in Ontario and Quebec. So we helped them restructure. We stopped. They piled up big sort of debts on the rent to all these locations because they were like had lease on these all locations. Then the franchisees were subleased, but the during COVID nobody paid rent to the landlord. Essentially, they accumulated big debt on their balance sheet. So we helped them stop that. We helped them settle what was on the balance sheet, a big rental area, and then we also helped them to get out of the bad sort of location which were not making them money. In that scenario, as we discussed, we took care of the problem on the balance sheet, made the income statement more cash flow positive, and hence for the viable, growthful sort of organization was brought out from it. So now we'll talk about the corporate bankruptcy. How would that work? So, so the filing will work in terms of there, like we discussed, there are many sort of tactical maybe advantages of filing a corporation bankruptcy. Many debts I can discuss with you, like CBA loan, HASCAP loan, even CSBFL loan. A good chunk of it, like HASCAP and CBA, template wise, until unless somebody is given a personal guarantee, like for a director or a shareholder, these were unsecured and they were sort of backed by the federal government of Canada, right? And CSBFL 75% is federally backed, 25% is personally guaranteed by a director, possibly, or a shareholder as well. So filing a bankruptcy at the corp level here, it can eliminate the unsecured part and something that doesn't flow down to the director personally. And there's one question that we usually see that people want to know that, okay, filing uh, a director or shareholder filing a bankruptcy, how it will affect sort of profile of the director and shareholder. I would like to iterate here, a corporate entity is a different entity from the director. And then we kept some of we pulled out before and after credit profiles of these directors and scores. And just to keep it in, filing a corporate bankruptcy won't necessarily affect the directors or creditors or the sorry shareholders profile personally, until unless there's two type of sort of obligation a director usually of a company has. One, if there's a personal guarantees given on our debts, or statutory sort of liabilities. Statutory could be HST and SUR reduction. But I'll tell you one thing, filing a corporate bankruptcy here at the corp level, even those HST and SUR reduction, many a time we see a good chunk, say if there's a $500,000 worth of CRA debt here, so that's accumulated over time. There's accrued interest and penalties. So if you file the corporate bankruptcy here, so it strips down the interest and penalties part of it, and the CRA then goes only after the principal portion. And even for the source reduction part, there are two components to the source reduction. One is employees contribution, which company sort of withholds and has to forward to the CRA, and then is employers portion of it. So you also get a strip down or a so taken out a good part of that portion as well, which is employer one. So this really helps strip down from say 500,000. It can potentially break down the liability to even 240 or 250, depending on what are the components in it. So now we've discussed about what a borrower has tools in the BIA. So not everything here is just for somebody who basically taken on the loan, but there's also avenues available for people who have sort of given out the loan, which are banks, family offices. So one option is court appointed receivership. So it allows, say, the bank to get a court officer, like I act as one, as two, and insolvency trustee can be a receiver. So a receiver takes possession of the business and then essentially runs it, shuts it down maybe, and then monetize that security or the collateral that the bank has and strips out or takes out the money for the bank and then take care of all the administration part. Because in Canada, there are various stakeholders who have different rights to it. It can be employees have different rights. landlords may have a priority right, or somebody or CRA might have a priority right. So all those administration part, licensed insolvency trustee act as a receiver and then take care of it and essentially get out bank whatever the money they could recover from a, say, quote unquote, a bad loan or a business that they try to restructure. Second could be a special loan department. Often you will see the banks are not in the business of killing the business. Banks make money by lending out money, right? They don't want to kill businesses because those are their clients and they want to make money. Keep, like, you don't want to kill the golden geese, but you only want the eggs, right? So they have a special loans department where the file gets transferred when some a bad business is not able to, make those payments, are in a bad situation. So they will try to work out on amended new payment terms, or maybe they will say, okay, we are seeing risk to our collateral. The collateral is maybe not good enough. The ratio doesn't make sense because the equipment values gone down or real estate gone down in terms of. So to make up those ratios, they'll say, okay, give us some more security, maybe another mortgage on personal house of the director. Like, there are various sort of ways that they essentially try to work out with the business or the individual to not really, take them to receivership. It can also include entering into forbearance agreement, which is a binding agreement which terms lay out that, okay, we'll give you 6 months, but during this 6 months you need to take care of all these conditions. You may need to have pay some cash upfront for it. So that forbearance agreement is also an option usually being provided by the bank's special loans department while it's there. It can be, but it depends situation wise and what all covenants were breached, and they think those can be even actually be dealt with at all. Then would be a creditor initiated bankruptcy. So this is something unique. Not a lot of people hear about it. That how can a bank put the company into bankruptcy? Doesn't a company put assigns itself into bankruptcy? So the court-appointed receivership to collect on the debt is usually used by the secured creditor. Secured would be a bank who has a collateral, or a family office, or an individual who took a mortgage, say a general security on all the assets of the company or particular real estate, right? So receivership is usually we see used in that scenario. Say somebody lent out money as debentures. I dealt with a situation where the individual gave substantial amount of money, but quote unquote to a startup in the form of debentures, which are now unsecured. So receivership wasn't a tool that he could access. But then we have this tool with the creditor. They can go to the court and petition to the court that, hey, this company is insolvent. It makes up all the requirements on getting into bankruptcy. Please assign the company into bankruptcy. That's called assigning or petition the company into bankruptcy by the court order, and wherein we acted as a trustee, quote unquote. And a part of the mandate of a trustee of a bankrupt company, estate, or whatever, is to administer the business and then an orderly distribution and monetization of the assets of the company. So we got in there, over the business, we ran it, we did some M&A, we sold it, and whatever money we collected, then again, per the rules and everyone's rights, we distributed it across. Also, this can help to do some financial investigation, and some will get into detail in the coming slide on it. So court-appointed receivership, as we discussed, usually is done by banks or family offices. Sophisticated lenders use it most of the times. Sometimes they don't do a full-blown sort of receivership. They can start with the soft sort of receivership, which would be getting powers from the court to able to monitor the business, like monitor their books and records, their bank statements. Like, say somebody has now were not able to work out with special loans. So bank doesn't has not to make a decision to really monetize and take over the business, because there's risk involved as well and cost that bank has to incur when they appoint somebody like us. So they might want to know more about the business at the same time while not taking on those risks of a full-blown receivership. Then they can use interim receivership mandate and investigative receivership mandate, where the powers are a bit limited of the officer which we act like, but we can do reporting, we can do monitoring, and basis upon that, an additional sort of intel that banks get, and we as a court officer also do our report, which can help both the court, the creditor, and the debtor to see where these things can go. Maybe give some comfort to the bank that, okay, it's not as bad as we thought. Let's give work with these guys for another 3 months and try to get them, keep them in the business. Or maybe through our report they get to know, no, it's actually worse than even what we thought. Then let's pull the plug. We want a full receivership. Our collateral is at risk that if we don't enforce today, if our security or our chances of recovery can wind down 50%. So that's some sort of mandate that goes onto it. Again, receiver act like a court officer, gets quite good powers from the court order. We can take possession of the asset, run the business, management, accountants, and stakeholders involved. They have to work with us and provide cooperation. Otherwise, it could be a contempt of the court, like quite a sort of powerful sort of a tool that helps an court officer get into the business, run it, sell it, and monetize it for the general benefit of the creditors, which are owed money in there. So in this one, I'll tell you, I've worked recently for a it was a family office wherein there was a shareholder dispute in the business. They of course try to work it out and see if they can really make it work. But then they did their security position analysis, the special knowledge sort of department. And then they thought this is not going to work because individuals are not going well. So we went in as a receiver. We took over the company again, ran it, sold it, and distributed the proceed, and took care of all the administration part of it as well. So as we just discussed, special loans department, first step a bank or a family business would take is usually getting to special loans where they will do analysis of what their securities position is, or the quote unquote, if they enforce today on the collateral they have, like real estate or the equipment or the business on the AR. They might they do analysis. Okay, if today we pull the plug and put the receiver, we'll get out 5 million from our security. And if now they have this request from the business, please give us another 3 months, then they do analysis, a good, bad, and average scenario, what it can happen. Like if there's a recovery, X recovery right now, how it will look up in all these three situations in next 3 months, and then it helps them to make a decision. Again, like we discussed, they can renegotiate terms, maybe get some additional security, and also enter into a forbearance agreement. So they don't want to again kill their clients and business. They care about the golden egg, but sometimes when they know this thing's not going to work, then they use these tools. And apart from receivership, sometimes we also see banks using power of sale, but that's usually used for, say, somebody has just mortgage on their primary residence, on one residence, because that's straightforward, lesser expensive process. But a lot of time when there's a complex sort of real estate involved, banks and sophisticated lenders use receivership still, because the receivership helps them and give the protection, because now there's a court officer who's selling it. In power of sale, it's the bank who sells it, and then they are exposed, or they have this risk on getting a claim. Say they are first, the second mortgagee on it who's owed money third. So say they sell it for X dollar, which only pays them the money that they are owed, and the second and third, they don't get paid anything. So this second and third sort of bank, they can sue the first one and claim improvident realization that, hey, you didn't sell the property right, you didn't list it right, these are things and that. So that's a risk that the bank would carry doing a power of sale. When there's a complexity involved and multiple risk involved, then they usually appoint a court receiver. Like there was one sort of a property, it was a complex one on Bridal Path Toronto. We took over as receiver because it if they didn't put a receiver in, one receivership is quite like power of sale, getting that possession can take months. Receivership is quite efficient and in terms of timing. So we were able to get in sooner, able to make sure all the security measures were put on so that the property doesn't go, in a bad situation. And then a court officer is selling on behalf of, say, all the creditors. So now, getting paid through the receivership process, the bank itself doesn't have that risk of improvident realization claim from the second and third one. And the receiver gets protection from the bank, because when we, say, have done a sale transaction finalized up, we go to the court, get it approved there. So everything is dealt with in a streamlined fashion and in a way that everything is protected and done in a whole sort of court process. So then we discuss about creditor initiated bankruptcy. Unsecured creditor usually, when they don't have the option of a receivership, they put the company into bankruptcy and can deal with it. I'll share with you a recent case study, or a case that I handled. So this individual sort of, not individual actually. So this was a vendor who, as you see in business transaction, usually the supplier gives about one sort of monthly sort of financing to the buyer, right? So in this case, this was a individual who imported goods from China. So the China supplier would usually, keep under or in the financing 30-day cycle, one payment of one shipment. And this um, vendor in Canada, they were getting out of the business, but they still get paid the last payment for the goods that they got from this Chinese supplier. And it was good, like tens of millions of dollars. All right. So this guy, instead of paying back what was owed to the China supplier, they did some, creative game, try to game the system and tend to wipe out the money from the bank account from itself and try to tell the supplier, hey, we lost money somewhere in a bad business decision and so that the China supplier now is in jeopardy. They can't collect. They don't have a security. So this China supplier put this company petitioned this into bankruptcy to the court order. We went in. So as a bankruptcy trustee, we have really sort of powerful tools in our hand. We did some forensic work in it, tend to go backward, tend to understand. We can also examine the director and the management under oath. So they have to pretty much tell us what really happened. So basis upon our investigation, we get to know what happened, what transpired, and we saw some red flags, how they pretty much try to game the system. Then as trustee, we have sort of a different wing of RCMP where we can report. We did a special report to for all this instances that happened of financial fraud or crime that happened. We reported to RCMP and got Interpol sort of involved into it. And then they were now, of course, Interpol and RCMP, they are not, so doesn't update each and every move of there, but now they are involved in trying to investigate and hopefully they're going to press charges. And similar sort of another mandate, we did the same, got RCMP involved, got the guy did a big financial fraud to their investors, which he supposedly thought he's gonna lent out or use their investment as a funding car loans, but instead it was 25% actual car loans given out, 75% was only paper loans. So we got in, we recovered the money as well. Also we got our RCMP involved, press charges, and court got the court involved, and this guy was charged and got the jail term as well. So again, so these are some real world case studies. So I think we've discussed quite a few from here, like the multi-retail franchisee store, like we discussed during COVID, took out a lot of rental areas. We helped them restructure the debts that were owed on the balance sheet, restructure the income statement that they can be cash flow positive going forward. Once that, then okay, yeah, this one is good. So it's a construction company. What happened? So there was a construction company up north about 100 plus years old. The management were, quite a bit vintage, and their now CFO was vintage. They did have good assets, I'll tell you, but the bank has different covenants and conditions to when they give out a loan, right? One part of it is audit reporting. So it wasn't a financial covenant breach. They didn't made bad on the installment. They were good with the payments, but they didn't report the annual statement. They were not in good communication with the bank in that time. So bank pulled down the trigger to appoint a receiver to take on the business, and essentially they will maybe run it or shut it or sell it to somebody else. So now this management is at risk to losing their business, and there were 100 plus employees who are at risk on maybe losing their whole jobs, right? So in part of the process of the receivership, to begin with, they have to send a formal 10-day notice that, hey, these are the default that you occurred. We're giving you 10-day notice to appoint a receiver, then we'll see you in the court. So the division one proposal, the option we discussed, it gives the protection. But like I said, timing is really crucial. So in that receivership sort of letter, that 10-day is the period. You need to basically, if you want to go through a division one proposal, you need to strike it within the time. So we got in, we struck it in the eighth day. I remember I was in India at the time. Then we sort of blocked the action of the bank. Then we try to figure out what the problem is, right? And problem was they weren't getting audit reports. We got another external CFO involved who now is working on audit reports. Then bank doesn't want to continue business. Of course they had like good assets, good real estate asset on there. We found us a new lender for them, who during this whole process, like initial 30 days and we get extension, who replaced the bank here. And now pretty much you solve the problem, you stop the action of the bank, and then the company is now still able to continue into business, which otherwise could have lost. Like these guys could have lost a big enterprise and people might be at risk at losing jobs, right? So that was a good mandate. We really added a lot of value there. And then one case was a professional service, a staffing company. they got a really big pilot program by CRA in past few years. They got like $5-6 million of liability because they reversed the position. A lot of these staffing companies were considering their sort of workers as subcontractors, not employees. So they had assessment from HST reassessed and source reduction. So they got big bulge of $6-7 million of liability from CRA. Then we use the division on proposal at the corp level, even though directors are sort of responsible here and could jeopardize their personal situation because directors can be liable, right? There are certain provisions. So we structured here, did the stay, and we restructured that money with CRA at the corp level, and we got them quite down to a fraction of the number, and then it was paid settled to be paid upon 4 or 5 years in interest free payment. That was quite helpful as well. Okay, I'll also talk about this action we took for another family office or a bank, wherein we monetize some assets in US. So the parent company was in Canada. We got appointed as a receiver. We got recognized in US. So we took over the US business as well. So we ran the business. This was women personal hygiene product company. So it was quite interesting one that we ran the whole company from Canada, selling out products, and then we did M&A part, sold it off. We got good money, and then we pretty much distributed amongst the creditors who were owed money. So I think we've discussed quite a bit about the railway world case studies and in terms of how the outlay of these things are. All right, so this is the interesting part, and I expected somebody to raise hand during what I was
So
kind of telling out. So the floor is the option to everybody. So shoot me
I
up
believe
some
you have already
questions.
been in very much detail.
Yeah,
Uh,
there has been quite a deal. Like it took
yeah,
me few years to understand everything, and I don't expect everybody to really
yeah.
understand in this 1 hour. But I would really love to hear about any questions because I know there might be
So
some.
Sudhanshu,
Yeah.
how it works, like in sense, if company has gone bankrupt and they are still having a compliances to be done,
Hmm.
so from where the money will come? Will the director will be putting from their own pockets? How the things will be like if company is already negative, there are no assets, there are more liabilities, but there are still compliances required to be done. Like suppose for us, CA, Chartered Accountancy, CPA compliances, CRA compliances, from whose pocket would those be done?
Okay, I'll tell you how it works. Say in a company, the director has certain liabilities and obligations.
Yeah,
HST and payroll is one of the biggest one in it.
yeah,
So the director, in order to get out of this situation in a nice fashion or streamlined way, they are
mm,
gonna be responsible, and they usually we see they will be the one who will be funding to their CPA to file the tax returns. See,
okay,
corporate income tax can still be thought about that maybe you might not, because that's an unsecured debt at the corporate level until unless there were some preferences and transfer, and like section 160 can be brought in. But HST
okay.
and source reduction is really something that a director who's
That's
in this
required to be
situation
done.
is required to be done. So they usually fund it themselves because they need to get out of the situation, right? So in a good fashion, otherwise they can get a good sort of big bulge notice themselves. So usually
Yeah,
we see directors and sometimes shareholders do that too. I'll tell you one more thing. Just did a recent file. Okay, it was about 20-30 million dollars total raised. We did the filing of bankruptcy for a really good reason. I'll tell you. So there's a
mm,
provision in Income Tax Act which is called ABIL. ABIL is allowable business investment loss. What that means is people have put in 20 million into it. Say everybody's put 400,000 into it, and now it lost the business, right? So there's a provision called ABL. ABL, what happens? Somebody who's funded 400,000 lost it. Now they can
mm,
claim ABL 50% of that 400, $200,000 as a write-off in their personal income tax return. Say somebody is in 53% bracket, and a lot of individuals were in this scenario. So now they were actually essentially able to recover 26% of their money. They put $400,000, but then they get a write-off of $200,000. They are in 53% bracket, so they essentially made back 26% of the amount that they invested through ABIL. So to claim the ABIL, they can claim other ways as well, but CRA gives a lot of complexities and compliance issues because CRA needs to make sure that the company or the person actually lost money. But when there's a certificate of bankruptcy of a company, CRA is then pretty much, they agree to it that okay, yes, if it's bankrupt, you actually lost the money, then it's comparatively very easier to get satisfy CRA that you lost money. Then you are able to claim that able loss. Like this file, Udit, we filed on December
Yeah.
31st. So you can
Okay.
imagine how much. So there are various tactical reasons that, and a lot of investors put in money themselves into this. It was
Yeah.
sort of no asset bankruptcy, nothing was there, but they funded us and all the CRA compliance, because then they were getting 26% return on their money, right?
Return on their money. Yeah. Yeah. And also, like only one of the resident is director. Only one is a Canadian resident, and other are sitting in India.
Mm-hmm.
So, is it possible for Indian resident to sue the other director sitting in India as well,
So
like
the
for the
Canadian
complaint?
director, or you say CRA to able to sue the Indian
Yeah.
directors?
So, first of all, can CRA sue the Indian directors? And secondly, can an Indian director sue the Canadian director can sue the Indian directors who are sitting in India for all the compliances for the out-of-pocket expenses the Canadian director has done out of his own pocket?
So I'll tell you how CRA's liability works. So it's called jointly and severally. That's
Yeah.
the terminology. So what it means, say there are four directors, one is in Canada, three are in India, right? So
Yeah.
CRA is gonna firstly try to go with the low hanging fruit. Person they
Yeah.
can attack more easily. They will go after, or they can go after. Like they have this option to who to get to first, right? So
Yeah.
in this scenario, if there are 3 years to one is here, they might want to go to somebody who's already in Canada rather than trying to
Yeah.
go to India, right? So this Canadian director may, get a good sort of letter from CRN asking, all right, the CRA that's here, compliance here, do it. And I'm actually doing
Yeah.
this case. I'll tell you this actual case. So the guy, a lot of time people just sign up as a director, not
Yeah.
actually getting to know what are the obligations, right? So this person, his friend was not a PR or citizen, and due to compliance of CBCA, which is a federal government, a Canada Inc. corporation, he signed up as a director just to help the guy. This guy didn't file a tax return for 3 years, didn't pay any dime, took out every money and spent it, right? So this guy didn't know all the obligations. So now, unfortunately, the guy who actually ran the show, he passed away. So now this guy is getting notices from CRA, the same situation, file the taxes, and CRA did notional assessment, as you know. They put
Yeah.
in a good, slapped in a good 100, $200,000 worth of liability on this guy. And now this guy thinks, I only helped a friend. Why am I being crucified? But they didn't
Yeah.
get into it and knowing. So we are now trying to help them to get out of that situation and avoid damage as low as possible. This guy is going to be filing the tax returns for sure and trying to settle the debt, because he's a director. CRA won't won't listen that okay, you were just a friend, or maybe you signed up without knowing it. They
Yeah.
expect you to know the laws before signing in as a director or doing anything pretty much. And then in terms of
Yeah.
your other part of the question, say the resident Canadian director, he paid out of pocket $20,000. Can he sue the directors of the corporation? See, it really depends. If it's just a compliance that was incurred, were those director liable to pay if they had some sort of agreement in there that everybody is going to have a like 25% share of all the compliance sort of cost that's going to go in? Then maybe they have a basis on it. But we just need to remember directors are liable. Say they might be liable to CRA, but they might not liable to the other director. But then for the severally and jointly liability that was paid upon, maybe there's a way out to go after it. Like I'm not a lawyer here, a lawyer. I'm an insolvency trustee, but I've
Yeah.
not come across a case when the director sued the other director for this. Like it can be, it can't be. See, things can be done, but it has to also cost benefit analysis wise make sense. You don't want to kill a rat with a nuclear bomb, right? So going
Yeah.
after an Indian, you need to now file something in India, go through their court system, spend a lot of time. Then you tend to see, is it worth it? But I'll tell you, this can be done. We have done cases, we've gone after people. Say, like I mentioned, this was in one was Hong Kong, Mexico, even in US. So there are provisions, but then it depends how far fetched and how much the money is involved, whether it's worth it or not.
Yeah. Yeah. And how much does it charge to hire a insolvency professional? How much, like, is it a success fee or is it like on each step? Um,
So
then
like we discussed quite few different tools, right?
yeah.
I'll just take you guys to few of them here. Okay, this one. So all these tools have different frameworks. different way the fees are structured by insolvency profession. Like in the consumer proposal, for instance, there is, and bankruptcy, there's tariffs, like the fees is basically regulated by the government for us, for a consumer
Yeah,
proposal and individual bankruptcy. So they are only few $1,000s, but it depends. Then again, consumer proposal, it is stayed up to like, I'll give you just a ballpark sort of number. It cost about $2,000 to do the cheap consumer proposal, and then the trustee also get paid from the portion from what the amount is settled. Say there was $200,000 of debt, you settled at $80,000. Trustee is also then able to get some money from the creditors for that 80,000 that they are getting. So that's how the consumer proposal work. For individual bankruptcy, there are two sort of different outlays that goes on to. If the bankruptcy is a summary, which means assets are less than $15,000, then again a small tariff comes in. It's not as big of a process. But when the assets are big enough, then the fees can range and depend upon what the complexity it is. So we usually as trustees charge hourly, but then there's two part of our practices. One is consumer, which takes care of consumer proposal, individual bankruptcy. Then is the corporate side, which is division one, corporate bankruptcy. It usually has a base to it for, let's say, division one and the corporate bankruptcy. Then we tend to build up our fees depending upon how much more time and more complexities and problems we want to deal with. So like a
yeah,
corporate bankruptcy of a company can maybe likely range depending upon each firm too, maybe plus minus anywhere 10 grand to 12 grand, and maybe sometimes lower too. It depends pretty much all the provisions. So every firm has a different sort of guideline on the competitive sort of market framework that they put their fees on. But that's usually the case. The corporate side is usually billable by the hours. Then we calculate how many hours we're going to spend in it, and then what are the costs and disbursement we're going to spend on it. That's usually how we build the fee into it. And then again, for even for the secured creditor side who want to recover money, we build in the same way. So it's usually a retainer upfront by somebody has to pay us, right? I know maybe everything is lost and then you're trying to recover money. Somebody either gives a deposit or a good enough guarantee will get paid, right? We can structure that up, depend again on the firm to firm. So that's how we
yeah,
pretty much look at it. And then there are various factors to be considered, right?
yeah. That's awesome. So, anyone else has any questions? Done. You have been awesome. Thank you. Thank you, Sudhanshu.